Welcome, everyone, to today's Explainer. We are diving deep into Apple Hospitality REIT and unpacking their highly anticipated Q1 2026 earnings. Now, if you follow real estate investment trusts, you already know APL is a heavy hitter with a massive portfolio of upscale hotels. But right now, there's a really fascinating tension surrounding this stock. On one hand, you've got this highly attractive dividend yield pulling investors in, but on the other hand, there are some undeniable underlying balance sheet risks pushing them away. So we're going to look straight at the financials and figure out exactly what's going on here.
To really understand where this company is headed, we first have to understand how management thinks. CEO Justin Knight actually kicked off this quarter's earnings call by stating, "Disciplined capital allocation has been central to our success over decades in the lodging industry." And that's not just standard corporate speak, it's literally the fundamental thesis of how they operate. They're constantly balancing near-term payouts with long-term positioning, really prioritizing operating fundamentals no matter what the broader economy is doing. And for a lot of investors, that operating thesis translates directly into this one massive number, 7.2%. That is Apple Hospitality's annualized dividend yield based on their regular monthly cash distributions. It's a huge number, and let's be real, it's the core appeal of APLE stock for income-focused investors right now. But as we all know, a yield that high always demands a much closer look under the hood to make sure it's actually sustainable.
Okay, let's dive into our roadmap for this explainer. We've got 5 quick parts today. First, Q1 2026 performance highlights. Second, the room's focused advantage. Third, decoding the dividend yield. Fourth, evaluating the bear risks. And finally, the 2026 strategic outlook.
Starting right off with Section 1, Q1 2026 performance highlights.
Despite facing some really tough year-over-year comparisons, their top-line numbers held up beautifully. Revenue per available room, or RevPAR, came in at $115, which is up 2.2% year-over-year. Occupancy ticked up to a very healthy 73%, while the average daily rate held steady at $157. What actually drove this? Well, it was significant outperformance in a few key major markets. For example, Pittsburgh saw a massive 23% jump in RevPAR thanks to events like the NFL Draft, while Seattle was up 18%. All of this localized demand translated into broad portfolio strength, with 2/3 of their entire hotel fleet delivering RevPAR growth.
And importantly, that top-line revenue growth successfully flowed right down to the bottom line. Comparable hotels' adjusted hotel EBITDA reached $108 million for the quarter. That's a 3.6% increase. And they did this through really prudent management of their variable expenses. For instance, they managed to keep their same-store variable hotel expense per occupied room to just a tiny 0.3% increase, which allowed them to generate a very healthy 32.2% EBITDA margin.
Which brings us to Section 2, the room's focused advantage.
So, how exactly are they pulling off these impressive margins while inflation is still a factor? The secret sauce lies entirely in their specific type of real estate. We are talking about upscale, rooms-focused properties operating under industry-leading banners like Hilton, Marriott, and Hyatt. By dedicating their square footage primarily to high-quality guest rooms, rather than underutilized convention spaces or those really expansive, labor-intensive resort features, they create an incredibly efficient operating model. Basically, they provide the amenities that travelers actually use on a daily basis. Think modern fitness centers, reliable Wi-Fi, inviting outdoor spaces. They skip the heavy overhead of full-service restaurants or massive banquet halls, because let's be honest, most of us just need a great bed and fast Wi-Fi anyway. This laser-focused approach drastically reduces their long-term capital expenditures and significantly lowers their break-even point. To summarize their structural edge here, 99% of their portfolio is rooms-focused. The average effective age of these properties is remarkably young, sitting at just 5 years old. That means they aren't staring down massive, deferred maintenance bills anytime soon. This is exactly how they keep those margins consistently north of 32%. It's a real sweet spot that appeals just as much to a corporate traveler on a Tuesday as it does to a family on vacation on a Saturday.
Add to that a highly diversified geographic footprint. They own 216 hotels spread across 83 markets in 37 different states. This broad scale acts like a shield for the portfolio. If a bunch of new hotel supply gluts a specific market in Texas, or there's a localized economic downturn in Florida, the overall portfolio is insulated by strong performance everywhere, from Alaska to Maine. In fact, at the end of the quarter, 57% of their hotels had 0 new upper upscale or mid-scale product under construction within a 5-mile radius. Moving on to Section 3, decoding the dividend yield.
We've established that the operations are incredibly efficient, but how does all of that translate into cash in your pocket? Well, for real estate investment trusts, we always look closely at modified funds from operations, or MFFO. In the first quarter, Apple Hospitality generated $80 million in MFFO. They paid out $57 million in distributions, which is effectively 24 cents per share, leaving a very comfortable $23 million in retained cash. So at least right now, that massive dividend is fully covered by the cash they are actually generating.
Zooming out to the trailing 12 months, the company brought in an absolutely staggering $1.4 billion in revenue. That is the massive cash flow engine required to sustain not just that juicy 7.2% dividend yield, but also to fund their ongoing capital improvements and any potential future acquisitions.
Now, we have to look at the other side of the coin in Section 4, evaluating the bear risks. Because to be a truly shark investor, you can't just look at the rosy cash flow. You must also neutrally evaluate the bearish flags. And the market is completely split on how to value this stock right now. On the bull side, discounted cash flow fair value estimates are hovering around $19.66, suggesting some pretty massive upside if earnings growth holds. But the bears are quick to point out that the stock trades at a trailing PE of 18.3 times, which is noticeably higher than the industry average. They also flag an unstable dividend history during previous macroeconomic shocks, suggesting that the current yield isn't an absolute ironclad guarantee if global travel suddenly slows down. But the real flashing warning sign for the bears, it's the company's dangerously thin liquidity. At the end of Q1, Apple Hospitality held just $8.5 million in cash and cash equivalents. Contrast that tiny cash pile against their total debt load, which sits at a towering $1.57 billion. Operating with such minimal cash reserves leaves them very little margin for error if a sudden systemic shock hits the travel industry.
So, the crucial point here is how management justifies this capital structure. They argue that the leverage is actually highly manageable. Net debt remains at a very reasonable 3.4 times trailing EBITDA. Furthermore, 63% of their outstanding debt is effectively fixed or hedged, which protects them from volatile interest rate spikes. And while yes, the cash on hand is low, they have $559 million in available liquidity on their credit revolver to tap into if they really need it. Plus, since they don't have any expensive near-term development projects looming until at least late 2027, their capital requirements are highly predictable right now.
Finally, let's wrap things up with Section 5, the 2026 strategic outlook. Knowing the strengths and the risks, a key part of management's strategy moving forward is selectively pruning the portfolio. For example, back in April, they sold the Hampton Inn & Suites up in Rochester, Minnesota, for roughly $9 million. This sale represented a 5% cap rate before capex and about 4% after you account for anticipated capital improvements. By selling off assets at lower cap rates, they can efficiently recycle that capital into much more accretive opportunities, or even use it for share buybacks. Looking at their roadmap for the rest of 2026, it's really a story of focusing inward. They've effectively paused open market acquisitions right now because there is a pretty meaningful gap between seller expectations and what APLE is actually willing to pay. So instead of overpaying, they're transitioning 13 Marriott properties to a franchise management model to drive better operational synergies. And for the full year, they plan to invest between $80 and $90 million to thoroughly renovate 21 of their existing hotels, ensuring that their current assets remain absolutely top tier.
Which brings us to the ultimate question for any investor looking at Apple Hospitality REITs today. Do their incredibly efficient operating margins and that robust 7.2% dividend yield justify the undeniable leverage and liquidity risks in what is shaping up to be an uncertain 2026 economy? The data clearly shows a highly competent management team running a well-oiled machine, but it's a machine that is running incredibly lean on cash. It's a classic risk-reward scenario. Armed with this explainer, it's now up to you to weigh the evidence. Thanks so much for tuning in, and keep learning.